You obviously bring it to tax situation, which is the reason we have Nicole here to speak about the fact that if you're transacting in Bitcoin, there's a completely different thing that you're going to get reconciled your wallet at the end of the year as to how much did the US dollar fluctuate. Imagine that scenario at the end of the year with your credit card spending, that you also got something that was a surprise. Oh, your currency increased in value and that while you spent it, it was increasing. So there's a short-term capital gain to deal with here. And so I have to ask you the question, Nicole, for our clients that are currently in Bitcoin and other cryptocurrencies, what can they expect from the end of the year? Most people have traditional brokerage accounts, Merrill Lynch, Morgan Stanley, they're like, you get a 1099, it's consolidated, it's got all their data on it, and they know. What can our clients expect that are already invested in this?
Unfortunately, not every trading platform is the same with what tax information they currently provide to those who utilize their platform, if any information at all. Some platforms like, Robinhood will actually issue you a consolidated 1099 at the end of the year if your capital gains or losses for the year exceed $10. Other platforms like Coinbase will actually issue a 1099 miscellaneous if you exceed more than $600. Something like Kraken takes a position that it's the individual's responsibility to determine what taxes apply. And as such, they don't provide any tax forms or statements. So obviously, what does this actually mean? For platforms like Robinhood and Coinbase, when they issue a consolidated 1099 or a 1099 miscellaneous, it's actually filed in duplicate with the IRS. So the IRS knows about it. They know it's coming. When the individual then files their tax return, they're basically providing information to the IRS that the IRS already knows about because it's ultimately already linked to your social security number. So that's easy enough. But now take it one step further. If the individual didn't report the income furnished on these statements, they'd have a problem, obviously, because, well, the IRS knows about it and they're not reporting it. So there's going to be a mismatch there. On the flip side, if you're trading through a platform that doesn't issue tax forms at all, then it's still on the individual to actually report the information and ultimately figure out what the proceeds are, what the cost basis is on their own. Either they can do this by perhaps downloading or exporting their trading history from the platform. Many platforms do provide this export feature, if you will. The biggest difference in this situation is that the IRS doesn't actually know about it. They don't have the information furnished to them yet. And I'll leave it at that.
So then I have to ask I got to focus. So then I got to ask the question on behalf of other firms' clients, certainly not my clients, not clients of WISP by any means whatsoever. But if there's this population of brokers, right? If there's this population that are supplying the data to the IRS and it's a known number to known entity, what about people that take a position and say, what's stopping me from not reporting this? I
So
I have not received any tax forms. Playing dumb. What would be and it's a loaded question. What would be the detriment to playing dumb to the scenario and trying to game the system, be smarter than the IRS?
I I would not play Russian roulette with that one.
Question is really what happens, right? To let people in on what would the IRS do in a situation where it was a known transaction to you and you decidedly didn't report it to the IRS.
So essentially, the IRS, and we can talk about this in just a little bit, they're ramping up their initiatives. They're getting funded with trillions of dollars by the budget reconciliation that's currently, being hashed out right now. They are ramping up their initiative for cryptocurrency and they know it's low hanging fruit. So essentially, if you don't report income that is taxable income to you, because this is taxable income to you, just because you might not be issued a government form that says, hey, you have a capital gain or you have a capital loss, it's still taxable income. And by law, you report all income, all gross income, unless it's excluded by law, unless it's deemed tax exempt per se. We're talking underpayment penalties, accuracy related penalties, for not properly reporting income it can really add up. And in cases of negligence or disregard for the rules and regulations, the accuracy related penalties it can be 20% of the portion of the underpayment of the tax that happened because of your negligence or disregard. And for example, and this is going to be a very basic example, but say you didn't report a bunch of crypto gains that would have ultimately accounted to $10,000 in tax, just using very low and round numbers here. You are easily looking at a $2,000 penalty plus interest. Now take that and extrapolate it as you may, because obviously there's a lot of people making a lot of money in this arena. Those penalties and interest can really add up. And good luck getting a penalty abated for reasonable cause because you didn't know you had to report it. It's going to be next to impossible to do that because obviously crypto didn't just come around yesterday. It's not really new. It's a hot topic and everyone knows about it. But strongly advised to not try to play Russian roulette there.
I agree. And I think clients that haven't been in the situation might not appreciate the fact that the interest rate that the IRS charges is slightly more than you're going to earn in a savings account from your bank. And so it is quite punitive and something you wouldn't want to get into. And the other side that I thankfully don't have to talk to clients about this, but it gets brought up from time to time, just conversational when people know that you're an accountant and you have to describe to them that it's one of the few things that people actually go to jail for these days
Yeah.
is the negligent underpayment of income taxes. And it's something that if the dollars are large enough where they're meaningful to you, it would be viewed by the IRS as gross negligence, a la fraud, and you'd be in, right, potentially a jailable offense situation. If it is that much money, be smart about it. Pay the tax, speak to an advisor, and get a best outcome situation for yourself, right? Own up, you made the money, right? That this isn't the time to pull the wool over. And anyway, I could continue.
No, and that just to piggyback on that, the current infrastructure bill is slated almost $79 trillion, I think,
Billion.
I'm sorry, million. I hit my too many there's to be set to appropriated for necessary expenses to the IRS to strengthen their tax enforcement activities, increase compliance across the board, and just modernize their information technology. Because yeah, we all know the IRS systems are a little bit archaic, but I'll leave you with just that. You can connect the dots and figure out what's next to come with the IRS initiative.
No, absolutely. The world of crypto involves long-term and short-term capital gains. With the
Mhm.
way that these assets are being exchanged for utility purposes, the majority of these are going to be short-term capital gains and they're going to be reportable at the end of each year. What can we expect for the tax system for the settlement of transactions that already took place in 2020? And what can our listeners look forward to in 2021? At least from
Okay.
now, our best crystal ball.
So yeah, your timing's impeccable with this one because obviously the recent release of the legislation proposal is out there right now. Markup sessions are literally taking place as I speak. So obviously there's been a lot of pushback on the initial legislation. So we'll see what actually shakes out. But I'm going to back it up a little bit because what Wayne had mentioned earlier, like selling stocks, anything that is bought and subsequently sold in less than a year seems to be short-term transaction. Anything that's a year or more is ultimately a long-term transaction. And this is important to note because the holding period essentially drives the tax rate. So currently, right now, short-term capital gains are taxed at ordinary rates, which are up to 37%, while long-term capital gains are taxed at a lower preferential rates, which right now are up to 20%. Tack on the additional 3.8% net investment income tax on top of that. And ultimately, we're looking at higher rates for short-term and long-term capital gains. But fast forward to the proposal, we're looking at tax rate increases. And it's ultimately twofold because, again, short term capital gain rates are up to the ordinary rates, long term capital gain, their preferential rate. Right now, they're proposing the top ordinary rate to be increased to 39.6%. Plus an additional 3.8%, you're looking at a 43.4% short term capital gain rate. Now, obviously, we're just talking federal here, state taxes as well. That's not obviously part of this discussion. That's a whole nother, forget about it for this moment. But so there's also a proposal out that the lower preferential rate for long-term capital gains will be increased from 20 to 25%, plus that additional 3.8%. So here we're talking 28.8% long-term capital gains. So in a nutshell, yes, rates are most definitely going up. Prior to the proposal, there was a lot of talk about the long-term capital gains rates actually increasing to the ordinary rates for high earners, but it seems like those rumors were only just rumors after all. Obviously, it's remained to be seen what the actual proposal will end up at, but right now that kind of is not in the current proposal. And just for edification, high earners are defined in the current bill as single taxpayers who make over $400,000 and married filing joint taxpayers who make over $450,000. I will say that I was also surprised to see that in the proposal, there's a 3% surcharge for married filing joint taxpayers who make in excess of 5 million and single taxpayers who make in excess of 2.5 million. So this is also just something to consider when you're talking about rates increasing as a whole, because obviously your capital gains factor into your overall gross income. And also just keep in mind that this is only for federal tax purposes, and state taxes, you'll want to factor that in as well, which depending on which state you live in, that can add a hefty rate on top of that. So
For sure. I know I've seen the writings recently and they're they're not rosy for our clients that live in New York and California and
No,
elsewhere. You
no.
quote a number that starts with a six, and I have people convulsing. But so that is what it is, and we're obviously going to do some planning there on behalf of our clients and be as helpful as we can. What I like to tell them all is we don't make the rules; we interpret them and we assist. And in that vein, I would want to bring up some of the challenges, thus opportunities when it comes to crypto assets. As we spoke about with William a little bit earlier, these things have utility. And so if people are using them much like they're using currency and they're trading in them and it's frequent, there's going to be frequent settlement. And so that means that we're going to have buys and sells in a frequent period in a short period of time. What that drags in for our clients that understand investing is going to be the wash sale rules. And so that's going to be, first of all, if I think about our clients that currently trade, I had a client about a year ago, just for story for edification, that told me, look, I built a bot and I did a little bit of trading and we made some money and I'm going to send you over the background data. And what they sent over was something around 80,000 lines of Excel of trades in and out of multi-currency. And we looked at it and we are like, okay, this is real. This is something that we've got to get our arms around. And so when we think about the systems that are being built to capture this data and to analyze this data, first of all, if you're in a Coinbase situation, if you're in Robinhood, it sounds like you're going to be okay because you're going to get reporting coverage.
You are. And that's the plain, simple, easy peasy ones. It's just, but it's the one that don't give you documentation that you have to really worry about.
So now for those people that are invested in altcoins that aren't covered in those, in our two examples, is there any way? So first of all, there's got to be somewhere for them to go in order to accumulate these transactions. And then secondarily, is there any strategy to apply that we can utilize or help clients with to help reduce that tax burden if they should have these short-term capital gains that are a result of just exchanging cryptocurrencies?
I know that a lot of the sites or that the platforms have data dump area where you can basically just export and do a big data dump of all of your transactions if they don't provide you with a tax reporting statement at the end of the year. As for how to assist clients with strategies and the first in, first out, specific education. Obviously, you want to look at your whole big tax picture. At the end of the day, you want to see maybe you have losses that you can, or gains that you can offset with other losses.
And what do you tell clients to invest in terms of crypto? It's, you can't answer that question because it's 1/10 of what you actually need to know in order to answer that question. So what I think we should leave our listeners with is there are ways to assist you with the outcome you're looking for in the event that you're looking to generate short-term capital gains. In the event that you're looking to generate, right? We're looking to help you generate the outcome you like to achieve the tax outcome that, we're both after. So all that to say, should be talking with us or whoever your tax provider is to come up with a strategy that matches your exact needs for the situation that you're in.
What I will say though, you did hit upon wash sale rules. Now, in the budget reconciliation legislation, there is a carve out that literally specifically identifies virtual currencies being included now. They amended the subsection of the Internal Revenue Code to include virtual currencies, and they are now subject to the wash sale rules because
Right.
previously they were not. Because obviously, like I said, the IRS is really catching up with this and they know it's low hanging fruit. They know it's a hot topic. So they're catching on pretty quickly and they make sure that they are making the money where they can and taxing the revenues that are taxable.
Right. And this is the play that we spoke about, whether this is viewed as a currency versus property, right? Because taxpayers wouldn't be subject to these same types of tax ramifications if they were simply exchanging currency for currency. If it was a dollar and I was exchanging it into pesos because I was traveling and I came back and I had a gain, it's a different experience than had I actually bought property and exchanged property for capital gain.
Yep. The IRS literally views crypto or virtual currency, as they like to call it, as the exact same as any other capital asset. And with that being said, gains and losses derived from buying, selling, their taxable income.
Correct. And so interpret that as you might like as a listener or watcher, that you can exchange other currency or you can exchange property and the tax treatment is different. And in this case, crypto assets currently, or the majority of crypto assets are being viewed as property and not as currency. So that's, I think, our parting thought with respect to the tax situation, is there anything else that you think is important for the listeners to be aware of when it comes to crypto or anything related to the blockchain in terms of their exposure?
Don't think you're smarter than the IRS because they know it's out there. It's a matter of time before they catch on to everything. And when they do, you don't want them to come knocking, because when they come knocking, you might have a unpleasant surprise of a tax bill and penalties and interest and maybe even jail time, God forbid. But just don't play Russian roulette. Contact your tax advisor. We know how to handle this.
I love it. That's perfect. It's the same advice. And I think that's very good advice.